All right, friends, there's a lot of fear out there that we are in another dot-com bubble. We have the largest tech companies in the world essentially missing earnings and laying off people. You can see right here, Meta has the worst week ever. Amazon tumbled 13%, and combined Alphabet, Amazon, Meta, and Microsoft lost $350 billion in market cap last week. And so times are tough. We're hearing about tech companies, big tech companies laying off employees. I'm going to get into that. I'm going to share my portfolio with you, every stock I own, my real money portfolio, because I like to show you what I own and not just talk about stocks. And then I'm going to get into some of the similarities and differences between now and the dot-com bubble, share my thoughts if I think we are in another bubble or not, and if we should just get out of the stock market and sell completely, and then share some perspective on the long-term performance of the stock market, just to give perspective. That doesn't mean that that's going to be what happens next. And finally, I'm going to tell you how I am preparing for a recession, a bubble, or whatever we're entering, and what I'm doing with my portfolio. All right, so let's get into this first article from CNBC. It was on October 28th. And again, we talked about how bad, the losses, right? Again, four of the largest and arguably most important companies in the United States, right, lost over $350 billion in market cap after they had concerning commentary for the third quarter and the remainder of the year between slowing revenue growth or declines in Meta's case and efforts to control costs. The tech giants have found themselves in an unfamiliar position after unbridled growth for the past decade. So we've got soaring inflation, rising interest rates, and a looming recession. You can see right here, Facebook came up short on earnings, recorded its lowest average revenue per user in 2 years, and said sales in the fourth quarter will likely decline for a third straight quarter. Meta had its worst week since the IPO in 2012, plunging 24%. Microsoft fell 2.6% due to a 7.7% decline after they reported earnings. They gave weak guidance for their next quarter, and they missed estimates for cloud growth. Amazon dropped 13% after giving a gloomy fourth quarter forecast, along with a dramatic slowdown in cloud computing unit. Those are supposed to be the two things that were just doing great and keeping momentum, was the cloud businesses for Microsoft and Amazon. So that's scaring people a lot. Okay, we're seeing ad revenue drop for everything from YouTube to Facebook to Google. And that's concerning. That's a sign of a recession. And so really the reason these stocks are dropping and that they have dropped is that, as we know, rates are rising. That tends to have a negative impact on growth stock prices. There's fears of a recession. These companies have missed earnings estimates or revenue estimates and brought down guidance. And they're having to continue spending money and have some of these rising costs with inflation, like wages and stuff like that. They're also cutting jobs, right? And I'm going to get into that next. And so finally, some of these analysts are out here lowering the stock prices. They lowered Amazon to 130 from 164. So that's the why. That's the why we've experienced some of this drop in the tech companies. Now, the thing is it's not just stocks, right? We're talking about layoffs at some of the largest companies and how it can hurt Americans. And right, so some of this is clickbait, right? It's just these news sites trying to get people to click and come and sell ads, right? But here's the deal. The largest companies in the tech companies really in the United States and in some cases in the world are either slowing down hiring or laying people off. And that's scaring a lot of people in there across the economy, right? Because they tend to be potentially leading indicators of other industries that are going to lay people off as well. So we've got Alphabet, Amazon, Apple, Meta, Microsoft, Twitter, and you've probably heard of other companies laying people off too. And so this is scaring a lot of people and making everyone compare right now, as well as the stock market struggling, to .com or even 2007, 2008. If you are new here and you like this comment, it really helps me out if you like the video and you subscribe to the channel. Helps more people find us, and it makes sure you never get an update. I do share my portfolio very transparently. I've got 115,000. We've been dropping, continuing to drop. We're at 114,747. I've put in 131,000, and so we're down 16,800. I cover these stocks and videos regularly. I do updates every single week, so just check out the videos in the feed or subscribe and make sure you get updated when I send out videos. But here's the list of my stocks, right? And I've got Meta as my top position, Snowflake, Shopify, Rocket Lab, Taiwan Semi, Tesla, CrowdStrike, Datadog, GitLab. So anyways, I'm invested in tech, right? These are the type of companies I invest in. These things are impacting my portfolio, and I'm going to share exactly what I'm planning to do and how I'm handling it coming up. Let's get to what exactly happened in the dot-com bubble and that'll open our eyes to how similar or different the situation is right now. So basically, between 1990 and 97, the percentage of households in the United States that owned computers increased from 15 to 35%. It made everybody super excited about computers, the internet, anything tech, right? Kind of sounds like crypto and Web3 and all that stuff and SPACs and all that stuff that happened. So there are some similarities here. A decline in interest rates increased the availability of capital. Okay, got it. Taxpayer Relief Act. So we've got lower interest rates, easy money for companies, taxpayer relief, money back in people's pockets. How similar does this sound to 2019, 2020, and even parts of 21 with COVID? As a result, everybody got super excited to invest at any valuation in any .com company, especially one that had internet prefixes .com in the suffix of its name, Amazon.com, Pets.com, all those things. Venture capital was easy to raise. How similar does this sound to what happened, right? IPOs fueled speculation and encouraged investment in technologies. SPACs, right? Okay, we have a lot of similarities here. But here's where it starts to be different. Between 1995 and 2000, the NASDAQ composite stock market rose 400%. And reached a price to earnings ratio of 200. Shares of Qualcomm stock in 1999 rose 2,600%. 12 other large cap stocks rose over 1,000% in value in one single year. 7 other stocks rose 900% in value. The entire NASDAQ rose 85%, and the S&P 500 rose almost 20%. Let's look at the NASDAQ price to earnings ratio right now. As of October 31st, 2023, you might not be able to see this, the price to earnings ratio in the NASDAQ was 23.23 compared to over 200 in 1999. That's 8 times higher in 1999 than it is now. That's difference number one. These are actually real companies with real earnings. Some of them certainly got overvalued, right? But nowhere near in terms of the entire NASDAQ as it was in 1999. The S&P 500 PE ratio, right now, I mean, this is just a quick chart here. It's showing right around 33, 34 leading up to, so this is in 1999. And right now we're down to around 20. And so we're about 50% lower, a little bit less than that in terms of PE multiple in the S&P 500 right now than we were in the .com bubble. And so we are not in the same situation with the .com bubble that we were in 1999 or 2000. Were stocks overvalued? Yes. Was there easy money? Yes. Was there a lot of excitement with SPACs? Yes. And we have corrected a lot. So we were closer towards the end of 2021 and early 22 than we are now for sure. But even then it wasn't that bad. But now with where we're at now and the PE multiples we're at now, we are nowhere near the valuations of the .com bubble. And so for me, for anybody with a long-term investment horizon, the best way to handle this is be valuable to your job and increase your skills, increase your effort at work and your productivity at work or in your own job, in your own venture, whatever you're doing. Protect your income. B, live below your means and save money, cut out excess expenses. That's what we're doing. C, don't invest on margin. Don't invest money that you need next year. I don't invest anything that I might need in the next 5 years. So I have the ability to withstand these downturns and invest through them. And if you do, these downturns tend to be over a long 5, 10, 15-year time horizon, the best time to invest in how you generate generational wealth and life-changing wealth. I don't know if we're at the bottom, if we're going to go down further. We might. But this is what the stock market has done over time. From 1996 to 2022, we averaged about 9% per year. From 1996 to 2022, inflation adjusted 6.8%. A lot of people will say that was just easy money policy, that we're never going to do it again. Well, over the past 200 years, this is according to McKinsey, the adjusted return in the S&P 500, inflation adjusted is 6.5 to 7%. That means you take inflation, you subtract that from the return of the S&P 500, you still get 6.5 to 7% per year on average over inflation that you are getting in the S&P 500. Investments are where I'm going to keep my money. I choose to do individual stocks. That's not for everybody. You can own simple ETFs that give you exposure to the entire S&P 500. One of my favorites is VOO. VTI is another great one that's a broader exposure to the stock market. And you can do that, put money in and never have to touch it until you are, within the time frame of needing that money, as long as you're not using margin and doing crazy things. This is what happens over the long term, even with all the fear in the market right now. Thanks for watching. Let me know what you're thinking in the comments. Are you scared? Do you think we're in a bubble type scenario, or do you think we're just going to get more of a pullback? And are you sticking to your plan? Are you changing things? Just let me know down in the comments. Always, I appreciate you liking the video and subscribing to the channel. It really helps us grow. Thanks.